I'm Paige Ellis. Welcome to Market Call. Dennis De Silva is on the show today. He's Managing Director and Senior Portfolio Manager at Middlefield Capital Corporation, and he'll be taking your questions on resource stocks. All right, let's bring in Dennis De Silva from Middlefield Capital Corporation to talk more about the markets and, of course, the Bank of Canada's surprise move today. The BOC hiking by a full 100 basis points. The market was expecting 75 basis points. So what do you make of a hike of this magnitude?
Well, pleasure to be here, Paige. Well, look, clearly the Bank of Canada has decided it wants to take a very aggressive approach to try and get ahead of this inflation scourge. And I think it kind of sets the table, I guess, in a way for maybe even the Fed to consider 100 basis points. I think we've certainly cemented 75 basis points for the Fed. But maybe after seeing what the Bank of Canada does, although they usually don't really pay attention to it that closely, maybe it opens the door to consider it, especially given that 9.1 CPI print.
You know, the Bank of Canada's governor, Tiff Macklem, noted that they were trying to front load his words, their words, the Bank of Canada's words. They're attempting to front load these rate hikes to avoid big rate hikes in the future. How much credibility does a statement like that have, or does the Bank of Canada have, when they delivered a surprise to the market today with the 100 basis point move?
Well, it's pretty clear by the 100 basis point move that they do want to front load it. You know, I think all the central banks, the key for them is how do I wrestle inflation, which is task number one, without driving too much of a stake into the growth story and making it so aggressive it chokes things off, perhaps too deeply with respect to economic growth. And perhaps too long. I know certainly at the firm we're in the case where we expect a shallow, relatively short recession. Some people use the term kind of technical recession right now. I think that's the balancing act for the Bank of Canada or the Fed or other central banks is just enough of a throttle or to prevent the throttle from going too far without choking things off for an extended period of time. We're
going to kick things off with an email. This was sent in by a viewer named John. He is wondering specifically, he's looking for Dennis's thoughts on Headwater Exploration. What do you think, Dennis?
Yeah, Headwater is a company that is led by a very strong management team. They've just done some consolidation of lands. They're an oil producer in Canada. I think they're producing around 11,000 barrels of oil per day. Quite an aggressive growth program that they've set aside. You know, one of the key aspects in looking at the Canadian oil and gas space is this concept of shareholder capital return framework. It's become very popular, and it's really how are companies looking at their asset base in terms of how much to grow it, balancing it off with how much excess capital can they generate and return either to shareholders in the form of base dividends, special dividends, or buybacks, as well as perhaps deleverage, continue to pay down debt or look at M&A. Headwater falls into one of the rare groups of all their intentions are built around sort of building up the asset base. And I think in this case, going from 11,000 to 22,000 barrels a day of oil by 2024. And then at that point, look at perhaps a more formal framework to deploy excess cash flow back to shareholders in various forms. So they fall in that category of a high growth company, creating good free cash flow, but probably intending most of that to be for perhaps more land acquisitions or further M&A in what is considered probably the hottest energy play in Canada called the Clearwater Formation.
And just taking a quick look at street consensus here, it appears there are 9 analysts who cover this stock, and all 9 have the equivalent of a buy rating. Okay, let's go now to a viewer. This is also an email. This is from Lalit asking for Dennis's thoughts on Marathon Gold.
Yeah, Marathon has a great little asset in Newfoundland. I think it's called the Valentine lake asset, and this is an asset that, because of its size, it's unlikely it's going to garner, you know, large company interest in terms of M&A. I think this one is going to be one that gets built, kind of like the Atlantic Gold a few years ago that we also owned. In this case, I don't currently own Marathon. They're in that kind of what I call sleepy mode. They're starting to go through permitting and financing and actually go ahead and start construction of the mine, which tends to be a time where there's elevated risk of execution. You know, are they going to build it on time, on budget? What kind of inflation will creep into it, and will it start and operate within a reasonable period of time according to plans? And so that's when you tend to see the stocks kind of go sleepy. In this case, you might see Marathon, as many other companies do, start to engage in a little more exploration regionally to kind of keep the market interested while they're spending most of their time building the project. So they've largely de-risked this asset. I think it's around the 3-4 million ounce deposit, probably produce 100,000 ounces a year, a little bit higher all-in cost for my liking. I think it's in that 1,100 to 1,200 US an ounce range, but still very profitable at today's gold prices.
All right, let's switch gears and take our first caller. This is Nick in Toronto. Nick, take it away.
Yes, my question for Dennis is on Cenovus Energy. I'm just wondering, with crack spreads at record high levels, would Dennis prefer integrated names such as Cenovus over regular oil and exploration names? And can you also just speak to the post-Husky merger, how it's changed the company? Look forward to your response.
All right, take it away, Dennis.
Yeah, we do own Cenovus. It's kind of one of the names we've picked up in some of our broad-based portfolio since the beginning of the year. I'll touch on maybe the first part with respect to, do you buy integrated or more pure play E&Ps? Generally speaking, our focus has been to own high-quality dividend-paying names, especially given the volatility in the market, and what we would see is continued volatility, certainly through the third quarter of this year. And so you want to stick with quality companies that kind of can withstand, in this case, lower oil prices, given it's an oil-leveraged company. They do have the advantage of having some upgrading or refining capacity, so that takes some of the sting off some of the elevated differentials that you're now seeing for heavy oil, for example. But I think that's something temporary, and has to do a bit with what's going on with strategic petroleum reserve releases in the U.S., and it's kind of distorting some of the refinery runs. But I think for Cenovus, it's a good name to own, very nice base dividend. I mean, it's only about 2%, but I anticipate that will grow given the framework as they continue to delever from that Husky acquisition that you mentioned. I think they've done a good job integrating it. I think if you listen to what I said about the company when they did the deal, I said, I think you just want to wait and see the integration go through. They're going to go through a little bit of indigestion. That period's kind of run its course. And it's nice to know they did the acquisition during a more beat-up period, and now they get to enjoy the fruits of the labor of that integration into a higher oil price environment.
And we were asked as well about the post-Husky merger. Do you have any quick thoughts on that?
Yeah, look, in hindsight, I think I mentioned when they first did the deal, I thought they were taking on a bit of baggage in terms of assets like Sunrise were not exactly good performers for Husky. They've now added this Asian gas component, which obviously bears very well in this era of higher structural gas prices, especially outside of North America. So I think that will bear some significant fruit. So I think obviously nobody knew at that time how timely it would be to acquire those types of assets. But I think they've done a good job integrating. Fortunately, you know, with strong oil prices, they've been able to delever much quicker than anybody anticipated, clean up the asset base, and really put themselves in a position to focus on an environment where higher oil prices really drive the bottom line with respect to things like free cash flow and return of capital to shareholders.
Let's go to Peterborough, Ontario now, where Jay is standing by with a question. Jay, go ahead. Jay, are you there? Can you hear us? Not there. So the question was about Tamarack Valley. So what are your thoughts, Dennis?
Yeah, Tamarack is an intermediate oil producer, has, I think, a dividend around 3% or so. Alberta-focused, very busy 2021, consolidating that hot play I mentioned earlier with Headwater in the Clearwater formation. This is a company that's going to grow very aggressively. I think from using a base of 2021 over the next couple of years, about 45% their asset base, and shifting obviously from M&A to more organic growth. And again, I mentioned earlier that shareholder return of capital framework. Right now, formally, they're targeting 50% of free cash flow to go to share buybacks, whether it's significant buybacks or an actual normal course issuer bid is to be seen. But that bodes very well, given this is an industry that in general has free cash flow yields, I'm going to say on the low end 15% to as high as 30%. A company like Tamarack's more in that 20% range. So if 50% of that is 10%, then that's a very healthy buyback of stock over the next 12 months.
Okay, let's go now to Chris. He's in Calgary. Chris, what's your question for Dennis?
Morning. My question is with regard to Suncor Energy. I know it's a resource stock, but it's also could be considered, other considerations in terms of value. The thing I don't understand is what's the share price going to do, given that there doesn't seem to be any sort of rhyme or reason to what shares are doing these days. Thanks. Have a good day.
And certainly we know Suncor's been in the news a lot recently. What's your view on this stock?
Yeah, I mean, I'll start with, it's very unfortunate, obviously, to hear about the fatality recently happened at their operations. I mean, a lot of people don't know. I think it's the 13th since 2014 and the 5th, I think, since 2021. So clearly there has to be a change in culture. We obviously know the CEO resigned in agreement with the board. But I think it probably goes a little deeper in that you do have to see, as the Elliott Group, which is an activist shareholder, indicated in their letter earlier this year, you have to see a real cultural change to improve safety at the company. And putting all the other important things that shareholders look for, I think that's probably top of mind now. It's not often what you talk about when you're speaking about resource companies, but it is kind of an underlying theme. I know a lot of companies, you look at their websites, they show how many days of, no injuries or generally speaking, and that's very important. So in Suncor's case, I think this kind of is a further wake-up call, secondary, obviously, to what Elliott said in their multi-page letter that outlined, I think, 4 or 5 different steps they'd like to see in terms of change. The company has obviously had a good return on the back of that shareholder activism. It's outperformed some of our other favored names like a C&Q or a Cenovus since that letter came out. So it's not a name we currently own. We do see some challenges there in the near term as the company kind of has to find its way. And as the caller mentioned, there certainly is a disconnect from perhaps what the underlying commodities are doing. And I think it's for some of these other issues which are just as important as what the commodities are doing.
You mentioned the fatalities, which of course are tragic. There's the fatality that happened last week was the 2nd this year and the 5th workplace fatality since 2020. And as you mentioned, the CEO resigning the next day. We haven't heard much from that activist investor in recent weeks. What can you tell us about their proposal and whether or not you agree with some of the things they were proposing that Suncor would change?
I certainly agreed. Well, they've obviously been silent. I think they were hoping to get some representation on the board or more aggressive representation, which hasn't happened. There's been, from my understanding, some engagement with the board. But certainly, as I alluded to earlier, the part about safety and the change in culture resonated with me, obviously, given the statistics you just mentioned on fatalities, which there's just no excuse for it. I think some of the issues about perhaps hiving off certain businesses, non-core, the renewables certainly come up in terms of wind and solar, some interest from other assets. I think they are looking at that, and they've indicated very strong reception from the market in terms of people looking to bid on those types of assets. So I think some of that cleanup will happen. But I think first and foremost, it really comes down to that cultural change needing to happen. And you'll probably see a CEO that comes from outside the organization, which I think is the only way you can kind of initiate that kind of change.
It's time now for Past Picks. Let's kick it off with Topaz Energy. That's TPZ on the ticker. We see a total return for that one of 16%. 4%. So it was recommended almost exactly a year ago, July 6, 2021. And as I said, total return 16%. What's been the story for this particular stock since you made the recommendation?
Yeah, Topaz is a unique hybrid of sort of royalties and infrastructure. Right now, about 85% of its revenue comes from the royalties, more gas weighted. This was a spin out from Tourmaline Oil back in 2020. And so it's headlined by its deals with Tourmaline, the largest gas producer in Canada. But it's also done a number of deals since we spoke with very good operators like Whitecap and Headwater, for example, and Tamarack, names we've talked about earlier. So very good exposure to some of the best plays in Canada, whether it's the Montney or the Clearwater. I think going forward, they'd like to do more M&A on the infrastructure side. I think their stated goal is to be a little more balanced versus they're more skewed now towards royalties. So it still continues to be a core name for us. I think the yield on it is around just over 5% or so. So very nice dividend, and we see continuing growth on that dividend as we see deployment of a very strong balance sheet going forward.
Okay, next up is Troilus Gold, which again you recommended back in July of last year. Since then, it's seen a total return of negative 49%. So what happened with this name?
You know, I can't say it's anything specific to Troilus. Nothing negative has happened with the asset. I think it's just a tale of the gold space, especially among junior or microcap gold explorers or developers. I'd say their performance is no different than the group, unfortunately. You know, you have an environment where gold has been relatively consistently between, you know, forgetting about where we are right now, but between kind of 1750 and 1900. And you've seen stocks come off anywhere from 30 to maybe even 70%, despite no fundamental change in the company. It's still a very high quality asset. Think of it like an earlier stage Malartic that a Cisco Mining had before it was sold to Yamana and Agnico Eagle, or at this stage of its size, it's about 8 million ounces and higher grade. It's like Detour. Detour had a 600 million market cap when it had 8 million ounces. And Troilus is 100 million market cap. So I think further de-risking will help. They expect another resource update and a pre-feasibility study by the end of this year, which will, again, kind of dot the I's, cross the T's, give people a better idea on costs, especially in this period of inflation that's impacting all development projects.
And the final past pick that you brought to us back in July of last year was Cisco Development. And let's bring up that report card. Total return of negative 71%. What happened with this name?
Yeah, sort of. This is a spin out from Cisco Royalties back in, I think it was late 2020. You know, the picture's changed a bit. More recently, they did an acquisition of a small producing mine in Utah that, you know, I think the visibility is you could probably see it grow to 100,000 ounces a year by 2025, 2026. On the back of that, there was significant dilution where they raised through different tranches, including a stream, about $300 million, which is intended to kind of front-end load the capex for building a mine in BC, their Caribou project, as well as expand the Utah mine to that capacity of, say, 100,000 ounces a year. Also, more recently, and perhaps what soured the market a bit, was an update on economics for that Caribou mine in BC, where, you know, although they've staged it differently, start smaller and then ramp up over time, the bottom line is with inflation and other increases over the years, we've seen the capex basically double for life of mine. And I think that's really squeezed the economics where the internal rate of return for the same kind of gold price to the previous economic study they did in 2019, it's went from about, I think, 44% to 16%, so certainly a little skinnier. So some work has to be done on kind of fine-tuning those economics, probably with the next, whether it's a pre-feas or feasibility study.
All right, let's get back to questions from our viewers. John is in Toronto. John, what's your question?
Yeah, hi, Paige. Paige, it's a real treat to talk to you. I really enjoy your reports, and I'm really glad to see you back on.
Thank you.
Keep it up. Dennis, I got one word, help. What's happened with Copper Mountain Mining? I know copper's on a downer, but Copper Mountain is expanding their mine in BC. They had opening up a mine in Australia. They borrowed $600 million. Now they sold that operation, but they have $600 million, which means somebody's got some faith in them. So I'm hoping that they're going to report they're going to maybe expand the mine in BC. But I'm definitely positive on copper over time, and I've been a long-time holder of copper, and they've been in operation for quite a while, so they have a good operation. So Dennis, help. I need your help. Please, your comments are really welcome. Thanks, Dennis.
Thanks for the question. And yeah, you're very up to speed with the company. It's been around a long time. It's a mine in BC. It has just completed an expansion that will probably grow at just over 10%. Look, at the end of the day, like Copper Mountain, a Capstone, very highly leveraged to the price of copper more than, say, a First Quantum or a Teck and things like that, not only because they're pure plays, but because they tend to be higher cost, a little more debt leveraged in some cases to copper. So their fortunes rise and fall with copper. And one of the big bulls on copper being even Goldman Sachs just revised their copper prices down in a recession scenario where I think their visibility is probably in the next 12 months, it'll be back to $4, but could be closer to $3 in the next 3-6 months. And you're kind of seeing that path work its way through in the scenario of a recession. And especially if China continues to have its kind of anemic response to activity with the subsequent openings and shutdowns, they're not going to help the cause. So I think there's nothing wrong with the company. They're in a better position than they were certainly a couple of years ago. Nothing like high copper prices, but they had a rough Q1. Some operational issues, prices or costs inflated to about $2.25 to $2.50 a pound. Certainly not the way to run things. But I think the second half we'll see a significant improvement. We'll also see a mine plan update, and that might include some cost updates given inflation as the reality for the mining space in general across and really all resources. So I think sit tight. Goldman, for example, still has a $6 plus copper price for 2024. So you kind of got to bear through the near-term volatility, not only for the commodities, but for the broad market. And I think you probably, if you don't own it, somebody who isn't John, and you want to dip your toe into a little more beta for copper, might be something to do in the fourth quarter.
I did a quick little search for that Goldman report that you mentioned there. Goldman Sachs obviously being one of the most influential cheerleaders for copper. The metal prices are now 40% below the bank's expectations, and Goldman is warning the slump could have much further to run. So that is a very fascinating report and a very recent one as well. Okay, let's go to Gulam, who's in Toronto. Go ahead.
Hello.
Hello. We can hear you. What's the question?
Okay, my question was, I think one of the past picks he had was Harte Gold, H-A-R-T-E, and the other one was Kelt Exploration. I don't see anything happening on Harte. Kelt has gone down a little bit. What's your view on those two stocks, and whether I should get out of it and put some money into Ivanhoe? If you have any opinion on that, I'd appreciate it. Thank you very much.
Go ahead, Dennis.
Sure. So we got a triple play here. So I'll be brief on Harte. I mean, the management has gone through significant change. Just couldn't get that mine to work right. Always stayed higher cost. Couldn't get the throughput to the level they wanted. It's a name we've been out of now for a while. I think I recommended it maybe 3 years ago. I would just move on. I think there's better ways to play gold. We might even talk about one of them in the next segment. With respect to Kelt, continue to be a very well-run company. I keep saying through this segment that, this is about how do I balance growth with a return of capital, very topical for the Canadian oil and gas space. This is a company that is a little different. It's more about accumulate land, develop net asset value, and then drill it and use the best drilling techniques and efficiencies to bring up cash flow to realize that net asset value, and then eventually sell it when you've kind of de-risked it to a certain degree, not drill it all the way, let somebody else spend the massive amounts of capital. So they're a little bit of a different fish, and they've done this already a couple of times. Management's a big shareholder. I think they at least own 20% of it. So it's a name I continue to like, especially if you're looking for a gas name to own in the Canadian space.
All right, let's go to Nizar, who is in Scarborough, Ontario. Take it away, Nizar.
Hi, Paige. Hi, Dennis. Crescent Point Energy has aggressively embarked on reducing debt, selling non-core assets, and returning cash to shareholders with 2 recent dividend hikes. With a possible increase in oil supply, assuming Saudis agree, what are future prospects for Crescent Point Energy if crude goes to $70 or $80? Thanks for taking my call.
Great.
Okay.
Thank you for the question. Crescent Point's a name that probably 3 years ago I wouldn't have touched. Very highly leveraged company, kind of known for going on M&A binges. There's been a lot of changes. They've certainly cleaned up the balance sheet. I think the yield is around 3.5%, so a nice little dividend. It's an oil producer, much more focused. That return of capital framework I keep talking about, I think their goal is to return now 50% of free cash flow to unit holders. So again, quite easy. We could see them buying back 10% of their stock in any calendar year, given their free cash flow yields north of 20%. So a nice balance of, I think, value in terms of it trades below its peer group, can return a significant amount of capital to shareholders in the form of not only a base dividend, maybe even some specials or an increase in the base, as well as that 10% buyback that we're very confident they can execute. So it's a name we've added to the portfolios since beginning of the year. It's not our core name like the one I'll use in the top picks, but certainly a very good name to own if you're looking for oil leverage in Canada.
And you were a little unclear about what the dividend yields. It's 3.8%. You were very close. Bravo, Dennis. All right, let's go to Abbotsford now, where we have Al on the line with a question for Dennis. Al, go ahead.
Yes, Dennis. Do you have a favorite nuclear energy stock?
All right,
Nukes. What's your preference in the nuclear space?
You know, I'm going to give you a boring idea, but it's kind of the benchmark or the proxy for uranium, which is Cameco, obviously in our own backyard here in Canada. We can't talk about yield because I think it's only like 0.5% or something like that in terms of a dividend, but I could see that growing potentially over time. Cameco has shown very good discipline in managing supply into the market. They shut down MacArthur and Cigar Lake, which they idled, my God, 4 years ago almost. And I think they'll bring that back into the market as they contract that volume out. I think they've been careful to say, we don't want to just bring a mine on to try and sell into the spot market, which can distort or bring down prices, which right now are just hovering below $50 a pound and going in the right direction upward. So I think they're smart in waiting till they could contract some more of the volume before they bring it on to try and manage the spot market. So a very good proxy for uranium, which I think looks very good going forward. I think there was a commissioner from the EU talking earlier on TV about how nuclear is part of the answer of how Europe will transition into cleaner fuels. It is part of their taxonomy that they announced earlier this year, and I think they just passed it through Parliament. And I don't mean your traditional nuclear power, you know, massive multi-tens of billions in cost. We're talking about, you know, the growth will come, I think, through modular reactors. Obviously, places like China and South Korea will still continue to build out massive projects. But I think the future will be more modular, smaller scale, lower capex. You could build them in strings to try and build out the capacity over time and take on less capital risk and execution and inflation risk.
Interesting stuff. Okay, let's go to Henry, who has been patiently waiting to ask Dennis a question. He's in Vaughan, Ontario. Henry, what is your question?
I'd like to know your opinion about Rio Tinto in view of the fact that we're probably all going into a recession and the price of copper is going very low. in previous recessions, Rio Tinto traded at half of the price it's trading at now. What's your opinion about buying Rio Tinto, let's say, 6 to 12 months from now, when the price is cut in half?
You're being very optimistic there. Geez, half. It's funny. One of my colleagues asked about it yesterday. BHP, Rio, Labrador Iron Ore came up, and, they're all kind of yielding 14, 15, 16% on dividends. And let's put aside specials that they declared over the last 12 months. But I think it's a reflection of you've had iron ore prices basically at some point they were over $200 a ton, and now they're closer to $100 basically. Still, like many other commodities, elevated compared to what we've been used to over the last 5 or 10 years. I'd say 3 years ago and back, it would average less than $50. So still extremely high. And that's without China firing on all cylinders. Now, the steel market looks particularly weak with respect to higher than average inventories and the lack of industrial activity. So that doesn't bode well for iron ore. I don't think even in a recessionary case, we're going to go back to $50, but in the sense of yield and what you could get paid while you're waiting, I think you'll probably normalize closer to that 7% yield, and it will be elevated compared to perhaps the 5% people were used to before, the last year or two. You're right. I do think certainly there's downside for those iron ore leverage names, because although you mentioned copper, iron ore is the biggest driver for BHP and Rio, and certainly Labrador Iron Ore. So I think there's a wait and see. I don't know if you have to wait 12 months. I think there will be some opportunities to dabble starting in Q4. It's not one of those scenarios where you're going to know what the bottom is. I think it's just a matter of once you think there's fundamental value, you start to buy it incrementally over time. It might be you decide over a couple of quarters, I'm just going to buy it a little bit every month and kind of average myself in, because we're never going to be able to predict what that absolute bottom is, especially when sentiment becomes part of the trade.
Okay, let's go to Timothy now, who's in Toronto. Timothy, what's your question for Dennis?
Hi, Dennis. Thanks for taking my question. I wonder if you could give me some insight into Alamos. This is a miner that has a lot of cash, has a lot of potential at Island Gold. I believe they're buying up Orford as well. And I wonder if you could tell me whether you think it's a good hold. Right now it's down, I think, down into the 9s from up in the 12s. Prior to this downturn. Can you give me some insight into whether you feel this is a good buy?
Yeah, it's a great question. As much as it's painful to see it go from 12 to $9, it's actually kind of normal performance for a intermediate gold producer. It doesn't stand out as being overly punitive. I hate to say it doesn't stand out. It is a solid little company. It is in a current net cash position. About 65% of its value, I believe, is in Canada now. Island Gold, which they acquired, I'm going to say 3 years ago, was a nice little acquisition, but I think it's bared fruit beyond people's expectations in terms of its expansion and cost structure relative to other projects that are out there. So I think that will continue to pay dividends in terms of helping the company maintain what's considered a pretty attractive overall all-in cost structure. I think it's around $1,000 US an ounce, which is certainly closer to the top tier for the peer group. It's a name I don't own now. I have to admit, we haven't really been adding gold names outside of in some of our specialty tax-driven products where gold has to be owned. But in our broader base portfolios, we really haven't been adding any gold, I'd say, over the last year. You just have seen a very weak sentiment for gold companies, whether it's large producers, intermediates, juniors, explorers, or developers. So it's not a place we would engage with at this point.
Time now for top picks, and we're going to kick it off with ARC Resources, which recently caught some praise from analysts at RBC. I was reading a summary of the note. RBC's analysts praising ARC for rewarding shareholders through its dividend and through share buybacks. Why do you like this name?
This is one of those premier gas companies in Canada. It's kind of a granddaddy among all the companies, been around a long time. Always very well regarded with respect to its management, and stewardship of the assets. It has all the right characteristics in terms of own their infrastructure, which helps them manage costs and kind of how they stage growth. Very solid balance sheet. They're in the right areas. It's a Montney gas producer, so it's a liquid-rich gas producer. I kind of intertwine it with Tourmaline, which has been a topic many other times, but I just figured, okay, I've said Tourmaline too many times, so I'll use ARC this time. Has a nice 3.2% dividend yield. Hopefully you'll correct me, Paige, if I'm wrong. I think the only overhang perhaps with this name is it is caught up, like Tourmaline, a bit with some of the First Nations claims in Northeast BC, which has caused kind of a moratorium on permitting. So their attaché asset, which is a high growth asset that they want to develop, like Tourmaline's Conroy, is a bit embroiled in that. Hopefully we'll see resolution and we'll see permitting open up before the end of the year, which will really take the reins off and allow them to exercise some further growth. But besides that, probably what RBC was referring to was, again, the infamous shareholder capital return framework, which they're targeting 50 to 80% of free cash flow, which right now they're yielding, I think, around 18% free cash flow yield. So I see no issue with them executing a 10% normal course issuer bid in the next calendar 12 months.
The dividend yielding 3.3%. That's what I see on my Bloomberg terminal here. And since we get asked so frequently about the street consensus, 15 analysts cover this stock, all have a buy rating. Let's go now to your second top pick, which is Whitecap Resources, that recently announced an acquisition. Tell us why you're interested in this stock.
Yeah, great. This is an oil leveraged name, so I kind of like to balance things off. Again, been around a long time. The XTO acquisition was $1.7 billion, highly accretive to the company, whether it's production per share, cash flow, free cash flow, it's north of 20% in all those measures. It was a cash offer. I think that created a bit of an overhang, even though management has been buying after the deal was announced, and that's always a positive sign. I think there was some concern about leveraging up again, especially in a higher priced environment for commodity prices, and also what it meant for shareholder return of capital. You know, does it disturb that natural process that people have gotten used to? I think management did a very good job of kind of tying in debt targets with increases in the base dividend. I think if they meet their debt targets, which should be reasonably accomplished under an $85 or higher oil price, they would increase the base dividend by 65% at the end of 12 months. I think there's two increments in there. If they meet their debt goals, I think it would be accomplished in 12 months. After that goal is met, they would then return, I think it's 75% of free cash flow to shareholders, again, probably in the form of buybacks, as well as increasing the base dividend, which right now, again, hopefully, Paige, I'm right, is 4.2%. So I think I see a very nice balance there. The XTO acquisition has very good growth parameters. They're going to go from, basically, I think they're going to double the production in the next couple of years and kind of stabilize it at that point. So it's a name that we find very attractive. We've owned it really for a number of years and have been adding to it since the beginning of the year.
So close. Dividend yield 4.3%. I think you said 4.2. So again, bravo.
Close. I'm getting better.
All right, let's go to your third top pick, which is CF Industries, which is a fertilizer play.
Yeah, and I'll start with the yield on this one. So this one's 1.8%, I think. This is the largest nitrogen producer in the world. The majority, I think only one of their plants is in the UK. Everything else is in North America, Canada, and the US. This is a bit of a play on gas. So it's the largest nitrogen producer in the world. Obviously, one of the three basic fertilizers, the others being potash and phosphate. There are two drivers for nitrogen and the upside. One is gas prices, because it is the largest cost input for producing ammonia, which we get nitrogen from. And I think being located in North America and the gas differential is just significant. You know, you're averaging, let's call it $6 in North America versus what you see at $30 plus in Europe. So a lot of supply coming offline, which bolsters their ability to sell into a strong nitrogen gas or nitrogen pricing market. The other dynamic is crop prices, which are elevated compared to history. So they're going to be able to benefit from farmers' incomes remaining strong, which means they can continue to buy important fertilizer inputs.